Imagine building a software machine so incredibly efficient that it accidentally starts deleting your own revenue.
Right, which is quite the paradox.
It's the exact paradox facing the enterprise tech world right now.
Hmm.
We are looking at a business that acts as the digital nervous system for like over 85% of the Fortune 500.
Yeah, they're absolutely massive.
Massive. They are churning out these huge multi-billion-dollar piles of free cash flow, and yet their stock has been slashed almost in half over the last 6 months.
Yeah, it's tumbling down into the $97 to $110 range, hovering right near those 52-week lows.
Exactly. So it forces you to ask a monumental question. Like, is Wall Street completely overreacting to the artificial intelligence boom? Or are we actually witnessing the death of the traditional per-seat software business model? Welcome to the Byte-Size Brief. Today, we are putting ServiceNow, N-O-W, that's N-O-W, completely under the microscope. Let's get into it.
It really is the defining tension in the tech sector right now. And the mission for our deep dive today is to really get to the absolute bottom of this massive market disconnect.
Right, because the narrative out there is just wild.
Oh, totally. So to do that, we are going to dissect ServiceNow, NOW's recent Q4 2025 earnings, unpack the rather complicated expectations for their upcoming Q1 2026 report.
Which are definitely complicated, yeah.
And we really need to critically analyze the looming threat and, well, the massive promise of what the industry is calling agentic AI. We have to understand the actual mechanics of how this AI is directly impacting their core business model.
I am absolutely ready for this.
Yeah.
But, before we start analyzing why the stock price is taking a nosedive, we really have to establish a solid foundation for you, the listener.
Yeah, context is everything here.
Exactly, because to understand why the market is suddenly terrified of AI disrupting this company, you have to understand the actual mechanics of what it is they're supposedly disrupting. Like, what exactly is the day-to-day utility of ServiceNow, N-O-W?
Think of ServiceNow NOW as the central, the operational engine of a massive corporation. If you look at a standard enterprise software stack, you usually have your customer relationship management tools handling the front office stuff.
Right, like sales and marketing.
Yeah, essentially how you bring money in the door. But ServiceNow, NOW, on the other hand, is the undisputed king of the back office.
Stuff the customer never sees.
Exactly. It orchestrates IT service requests, human resources onboarding, legal workflows, security operations, all of that.
So it's the invisible plumbing that connects entirely different departments.
Yeah.
Like if a new employee gets hired, they don't just need a desk.
No, definitely not.
They need an HR profile, payroll setup, a company laptop from IT, specific network permissions from security.
Right, and without a centralized system, that onboarding process is an absolute nightmare of scattered emails, manual Slack messages and spreadsheet tracking.
Oh man, spreadsheets, the absolute worst.
Yeah, it's chaos. So ServiceNow, NOW, routes all of those distinct tasks through automated, trackable workflows so nothing falls through the cracks. It is literally the infrastructure that keeps the corporate wheels turning.
Okay, that makes sense.
But, and this is the core of the current bear case, the exact reason the market is hitting the panic button right now comes down to the fundamental mechanics of how they bill their customers for that plumbing.
Ah, okay. This is where we get into the infamous per-seat pricing model, right? Like the golden goose of the software industry for the last decade.
Precisely. Historically, ServiceNow NOW charges based on seats, meaning they sell individual employee licenses.
Got it.
So the more human employees a large company has actively logging in to resolve IT tickets or process those HR forms, the more lucrative licenses ServiceNow NOW sells.
Which is great for them when companies are hiring.
Exactly.
Yeah.
But now they are heavily introducing agentic AI into their own ecosystem. And these aren't just, basic chatbots that give you a link to a FAQ page. These are autonomous AI agents that can actually reason, make decisions, and execute multi-step workflows entirely on their own.
So basically, it's kind of like if their new AI can automatically fix IT tickets, a company doesn't need to pay for 1,000 human IT guys to have ServiceNow NOW accounts.
That is the exact existential pricing dilemma keeping institutional investors awake at night.
Wow.
Yeah, and the data validates just how powerful these new tools are. ServiceNow NOW recently launched a product called the Level 1 Service Desk AI Specialist.
Okay, what does that actually do?
Let's look at the mechanics. Historically, if you get locked out of your corporate server, you submit a ticket. A human IT worker reviews it, figures out who your manager is, emails them for approval, waits hours for a reply.
Oh, I've been there.
Right.
Uh,
And then they manually click through 5 different administrative screens to reset your permissions.
Which takes hours or sometimes days, depending on how backed up the IT queue is.
Exactly. But with the AI specialist, the AI reads your intent the absolute second you submit the request. It instantly checks the corporate organizational chart, pings your manager via a direct message with an automated approve or deny button,
Oh, wow.
and the absolute millisecond your manager clicks approve, the AI executes the server command. So a process that used to take 3 days now takes 3 seconds.
That's insane.
Yeah, they are reporting that this system resolves cases 99% faster than human agents.
That is a staggering leap in productivity for the customer. But,
Yeah.
as an investor, if I'm looking at that, I'm thinking, wait, if the AI is doing all the work, my customer is going to fire half their IT staff,
Which means,
which means they're going to cancel half of their software licenses with us.
right, which theoretically means collapsing revenue for the software provider.
Yeah,
And you can see this exact panic reflected perfectly in the stock chart over the last half year.
been rough.
Very. The stock plummeted 44.6%, hitting those 52-week lows, accounting for their recent stock splits.
Hold on. How does that actually affect ServiceNow NOW's stock price for regular investors like me?
Well, it fundamentally alters how the market assigns value to the company's future earnings.
Okay, unpack that a bit.
In the finance world, we measure this using the forward price to earnings, or PE ratio. A year ago, investors viewed this company as an unstoppable growth engine.
Right, they could do no wrong.
Exactly. So they were willing to pay a massive premium, giving it a sky-high forward PE ratio of 153 times earnings. They were paying for massive future growth.
That is a hefty premium.
It is, but today, that forward PE has compressed violently down to about 26 times.
Wow, 26. So to translate that for you, the listener, the market no longer views this stock as a high-growth rocket ship.
Not at all.
It's being priced much more like a mature, slow-growing utility company. Like, if you buy in now, you are essentially betting that Wall Street's fear about AI killing their growth is dead wrong.
Exactly. The market is essentially saying, we don't believe you can keep compounding your revenue at 20% a year if your customers don't need to buy as many human licenses.
The premium for hypergrowth has completely evaporated from the stock price.
It's just gone.
Okay, so compared to last quarter, what actually moved the needle here? Because we have this terrifying, highly theoretical narrative about the death of the seat model, but we need to look at the actual hard financial data.
Yes, the actual numbers.
Right. Is the business fundamentally breaking from the inside? Or is Wall Street just caught up in a panicked, forward-looking narrative?
This is where the story gets truly fascinating because the hard data on the spreadsheet tells a completely different story than the fear driving the stock chart.
Really?
Yeah. If you look at their Q4 2025 earnings reality, the underlying business is absolutely thriving.
Hit me with the numbers.
Total revenue hit $3.6 billion for the quarter. That is up 20.5% year over year.
Wow. Maintaining over 20% growth at a multi-billion-dollar scale is incredibly difficult.
It is exceptionally rare.
That's massive. And what about their profitability while achieving that growth? Like, are they just burning cash to do it?
Not at all. If we look at their operational efficiency, they hit an elite Rule of 40 score of 64.9.
64.9. Okay, for context, the Rule of 40 is a benchmark metric in the software industry that simply adds a company's revenue growth rate to its profit margin, right?
Correct. The golden rule is that if the combined number is over 40, you have an exceptionally healthy business.
So hitting nearly 65 proves they're growing fast while remaining incredibly aggressively profitable.
Precisely.
But what about the AI? I mean, is it just cannibalizing them, or are they finding a way to make money off of it right now?
The most bullish data point in the entire earnings report is actually their AI product monetization.
Oh, interesting.
Their core generative AI offering, which they brand as NOW Assist, more than doubled its net new annual contract value year over year.
The bell bowl.
Yeah, it just surpassed $600 million in annual contract value.
Wait, so let me get this straight. They are actually making over $500 million in recurring revenue directly from the very AI products that the market thinks are going to destroy their business.
Yes. They aren't just running, free beta tests or conceptual pilots. They are actively and heavily monetizing these tools.
That completely flips the narrative.
In Q4 alone, they secured 244 new contracts worth over $1 million each. Enterprise customers are happily opening their wallets for this efficiency.
Okay, I have to aggressively push back here.
Go for it.
Because their Q4 earnings are like looking at the scorecard of a marathon runner who just crossed the finish line with a personal best. If the numbers are this undeniably good, if they are closing massive million-dollar deals and hitting elite profitability scores, why are institutional analysts actively cutting their price targets?
That is the big question.
Right. We literally just saw BTI cut their target from $200 down to $185. And why did the stock just have its worst week in 2 months right after these announcements? There has to be a catch hidden in the details.
You are absolutely right to be skeptical. And yes, there is a very real catch.
I knew it.
It lies entirely in their forward-looking guidance for Q1 2026. While the historical data looks phenomenal, their immediate future has some serious roadblocks. First, management explicitly flagged a 150 basis point headwind expected in Q1.
Okay, let's avoid the financial jargon for a second. A 150 basis point headwind basically means a 1.5% drag on their growth rate, right? Why is that happening?
It is happening because of a strategic mix shift away from self-hosted revenue toward cloud-hosted revenue.
Oh, the classic cloud transition.
Exactly. They are transitioning their legacy customers who host the software on their own private servers onto ServiceNow, NOW's modern cloud infrastructure.
Which is good long term, right?
Very good. In the long term, moving customers to the cloud is fantastic for retention and upselling. But in the short term, the accounting rules require cloud revenue to be recognized slowly over the life of the contract.
Whereas self-hosted revenue is often recognized upfront.
Right. So that accounting quirk creates an optical drag, making their immediate growth look artificially slower than it actually is.
Okay, I can forgive an optical accounting drag, but is there a fundamental business drag?
There is. The bigger issue is that their overall growth rate is increasingly being propped up by acquisitions rather than organic expansion.
Oh, that's not great.
No. They recently spent heavily to acquire an AI company called Moveworks. Moveworks specifically is a platform that automates employee support via natural language.
Okay, so buying growth.
Exactly. If you back out the new revenue brought in by that Moveworks deal, you uncover what would otherwise be a slight deceleration in ServiceNow, NOW's organic growth.
Ah, so it masks the fact that the core original business might be slowing down naturally as it fully saturates the Fortune 500 market.
That's right. But the absolute biggest red flag of all, the one that really matters for retail investors trying to analyze the true underlying profitability of this company, is their heavy reliance on stock-based compensation.
Or SBC?
Yes, FTC.
I was waiting for this. The classic tech industry accounting illusion. Explain the mechanics of this SDC problem, because this is where a lot of retail investors get burned.
In fiscal year 2025, ServiceNow, NOW's stock-based compensation, was nearly $1.95 billion.
Wow.
To put that into perspective, that is roughly 15% of the entire annual revenue.
That is a massive chunk of change.
It is. Now, on their earnings release, they report a massive, beautiful $4.6 billion in free cash flow. That headline number looks amazing to a casual investor.
Of course it does. $4.6 billion sounds incredible.
But when you realize they are paying their employees nearly $2 billion in company stock instead of actual cash out of the bank, it artificially flatters that cash flow number.
Wait, so they are boasting about $4.6 billion in free cash flow, but nearly half of that is just them printing new stock to pay their developers and executives.
Pretty much, yeah.
As an investor, that feels incredibly deceptive. Doesn't that just dilute the value of the shares I'm holding?
It absolutely dilutes your shares. Think of it this way. If you own 1% of a pizza, and the chef decides to cut that exact same pizza into twice as many slices to feed his staff, the pizza itself didn't get any bigger.
Right.
Your individual slice just got smaller. You own less of the total pie.
That's a great analogy.
So when the market sees a slight slowdown in organic growth, combined with heavy shareholder dilution from stock-based compensation, institutional investors get very nervous. It forces them to question the actual high-quality nature of that free cash flow.
Man, that's rough. So if the core business is facing this much dilution, natural market saturation, and the looming threat of AI cannibalizing their seat licenses, management can't just sit on their hands.
They definitely aren't.
Right, they have to find entirely new, massive revenue streams that AI can't easily destroy.
Is that why we're seeing them suddenly go on this massive M&A spree into entirely new sectors?
That is exactly what is happening. Management knows the AI per seat threat is real, so they're going on the offensive.
Makes sense.
Their strategy right now is to aggressively buy their way into highly critical, incredibly sticky sectors, specifically the cybersecurity and identity management space.
Let's dig into the mechanics of that defensive moat strategy. What exactly are they buying to protect themselves?
They recently announced the pending acquisitions of two major specialized companies, Armis and Visa.
Okay, what do they do?
Let's break down why they bought them. Armis specializes in extreme asset intelligence and security. They can see every single device, from laptops to factory sensors, connected to a corporate network.
Very big brother, but necessary.
Exactly. Visa focuses on identity access governance, meaning they control exactly who or what has permission to view or alter secure data.
The strategic goal here is to combine these tools with their existing platform to build what management is calling an AI control tower.
An AI control tower. Explain how that actually works in practice.
Well, think about the AI agents we discussed earlier.
Right, the autonomous ones fixing IT tickets.
Exactly. If you are going to let autonomous AI agents run completely loose in your corporate network, provisioning software, changing HR payroll records, altering IT permissions, you need absolute ironclad visibility.
Right, you need identity management to ensure those AI agents don't hallucinate or get hacked and do something catastrophic.
Exactly. How does the system know the AI requesting a password reset isn't a malicious actor? By acquiring Armis and Visa, ServiceNow, NOW, is attempting to position itself as the ultimate governor of all corporate AI activity.
Which is a huge market.
Massive. They are attempting to triple their total addressable market by expanding deeply into enterprise security and risk.
They want to be the bouncer at the door for every single AI transaction in the company.
Yes.
But wait, I've read that massive competitors like SAP and Salesforce are aggressively doing the exact same thing. Like they all want to be the ultimate AI orchestration layer for the enterprise.
They are. The enterprise software space is currently in an absolute arms race to become the central AI hub. SAP is heavily pushing their business AI, and Salesforce is practically betting the entire farm on their autonomous Agentforce platform. They are all trying to convince the Fortune 500 that, well, they are the best solution.
Right, but what does all that actually mean for ServiceNow and OW investors?
It means the entire competitive landscape is violently shifting. For the last decade, these companies competed on managing human workflows. The next decade will be a war over managing machine workflows.
Which is a totally different battlefield.
Exactly. For a ServiceNow NOW investor, these cybersecurity acquisitions signal that management is trying to embed the software so deeply into the fundamental security and identity infrastructure of a company that ripping them out in favor of a competitor becomes practically impossible.
It makes me wonder about their overall strategy, though.
Yeah.
I have to ask, are they digging their defensive moat deeper? Or are they just buying other castles because their original fortress is under attack?
That's a fair question.
I mean, spending billions on acquisitions while facing core business deceleration feels a bit like a desperate defensive scramble.
It is a completely valid concern, and it is exactly why the stock is sitting near those 52-week lows. But if you look objectively at the strength of their existing moat, it is still incredibly formidable.
Okay, give me an example.
Perhaps the best proof of this is their recently announced 5-year co-creation deal with Visa.
What does a co-creation deal actually entail?
It means Visa isn't just buying off-the-shelf software licenses anymore. They are actively partnering with ServiceNow, NOW's engineers, to completely transform their end-to-end payment conflict resolution business.
Oh, wow.
Yeah, they are literally building Visa's future operational infrastructure together on the platform. When large, highly regulated global enterprises like Visa are doing that, it proves they aren't looking for an excuse to rip this software out when AI gets better.
They are intentionally embedding it deeper into their DNA.
Exactly. And if you look across their entire customer base, they consistently maintain a 98% renewal rate.
That 98% retention rate really is the anchor for the entire bull thesis, isn't it? When a customer signs up, they basically never leave.
Precisely. Because once you wire your entire HR, IT, legal, and security operations through a single interconnected platform, the switching costs become astronomically high.
Unimaginably high.
Yeah. If a company wanted to leave, they would have to completely retrain thousands of employees, rewrite years of complex compliance protocols, and risk massive operational downtime.
Nobody wants to do that.
No one. That inherent stickiness buys management vital time to figure out the AI transition without losing their customer base overnight.
So if we pull all of these threads together and summarize this deep dive for you, the listener, ServiceNow, NOW, is an absolute cash-generating machine with elite enterprise retention.
Absolutely.
It's a product that the Fortune 500 literally relies on to keep the lights on.
Yeah.
But right now, it is caught in a brutal, unprecedented tug-of-war.
Yes, it really is.
On one side, you have amazing AI product growth, massive million-dollar deal momentum, and a brilliant expansion into cybersecurity.
The bull case.
Right. And on the other side, you have a market terrified that these incredibly efficient AI agents are going to cannibalize the company's own highly lucrative per-seat billing model.
Combined with some organic growth deceleration that is being masked by acquisitions and heavily diluted by stock-based compensation.
That is the perfect synthesis. The fundamental day-to-day utility of the business is highly robust, but the narrative, and more importantly, the pricing model, are under severe existential pressure.
Which brings up a critical structural thought for you to mull over as you analyze not just the stock, but this entire sector. If these new AI agents successfully do the work of 10 human employees, it permanently changes the entire geometry of enterprise software value.
Because the value is no longer tied to human headcount.
Exactly. The question isn't whether the AI will work. We know it works. The question is how it gets monetized.
Right.
The entire software industry is facing a crossroads. Will ServiceNow NOW be able to seamlessly transition to a pay-per-action or a consumption-based pricing model, successfully capturing the massive financial value of the specific outcomes their AI generates?
Or will they be trapped in an outdated per-seat paradigm, watching their revenue inevitably shrink, even as their software becomes more powerful and more useful?
That truly is the billion-dollar question.
If they can figure out how to successfully charge for the concrete value the AI creates, like a percentage fee for every automated HR resolution or security fix, rather than charging for the human seats the AI eliminates, this recent dramatic stock drop might look like a massive historic overreaction in hindsight.
But if they fail to adapt the billing model, that PE compression might be entirely justified.
All right, listeners, what's your take on the future of ServiceNow? NOW. Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.